Hello and welcome. You're with us here in Business Today. I'm Abha Vakaya. Here are the day's top stories. Massive layoffs by Facebook parent company Meta in the US. 11,000 employees to be given the pink slip. It's one of the biggest tech layoffs ever. Indices end down after volatile trade as global concerns trump a great results season. Nifty down 46 points. Sensex loses 152 to close at 61,034. Rupee rallies against the US dollar amid political uncertainty in the US. Jumps 48 paise in trade today, up 1 rupee 44 paise in 3 trading sessions. Tata Motors posts higher than expected losses of 945 crore rupees in the July to September quarter. Revenue jumps 30%. The company says it sees margin recovery on improving chip supply and cooling commodity prices. Morgan Stanley goes super bullish on the Indian economy, says India will overtake Japan and Germany as the third largest economy by 2027. GDP seen touching $8.5 trillion in 10 years. Elon Musk's wealth plunges below the 200 billion mark as Tesla shareholders get jitters about his interest in Twitter. Shares fall to a 19-month low. Musk is still the richest man in the world. Big win for the Modi government. Nirav Modi to be extradited to India from London. Loses appeal in London High Court against being deported to India. Facebook's parent company Meta has laid off 11,000 jobs globally. The company has taken this step to cut costs. The move comes days after Twitter fired more than half of its workforce. It also comes at a time when big tech companies like Amazon and Google have announced a freeze in hiring. The move has been confirmed by Meta founder Mark Zuckerberg, who said he has decided to reduce the size of his team by about 13% and let off more than 11,000 of their talented employees. For more on this, we're joined by our tech editor Ayush Alawadi, who's currently in Boston, USA. Ayush, the mood quite somber on account of these mass layoffs that we're seeing in big tech.
Abha, you summed it up perfectly. Somber is the mood. In fact, at breakfast earlier today, I was sitting with a bunch of tech journalists who cover these FANG companies, and the mood seems somber because they've been in touch with their sources. And of course, so many people at these tech companies, 11,000. Right now, that is a massive number. That's nearly 13% of Meta's workforce. And this is a company which was valued nearly at the $1 trillion mark almost a year ago. Spent lavishly over the years, acquired companies like Instagram, WhatsApp, did all sorts of things, copied all sorts of features, had massive scrutiny over its data practices. None of that made a dent in terms of what Meta stood for. But it seems like this one costly bet called the Metaverse, ironically, that's what it's called, has really cost him dear. They posted a 50% slide in quarterly profits last month. And of course, their stock has dropped nearly 70% this year. The mood is truly somber, especially like you said. This comes with a spate of other layoffs in the top tech companies here in the US. We saw what's happened at Snap. There's tech hiring freezes all over. And of course, we've also seen what happened at Twitter. But with Twitter and Elon Musk, there was a U-turn here. Of course, employees would hope that's the case, but it's seeming like it's most definitely not.
Ayush, thanks so much for taking us through all the latest, and we hope to see more of you while you're there in Boston. Meanwhile, the Lal Street witnessed a choppy session back home. The two major indices ending slightly lower. The benefit of gains in banking stocks was offset by the impact of weakness in global markets. Despite the Nifty 50 and Sensex hitting their near 10-month highs over the past two sessions, gains were limited as the underlying worry of expensive valuations prevented investors from placing aggressive bullish bets. While the Sensex lost 152 points to end at 61,034, the Nifty was at 18,157 at close. Top gainers today: Adani Ports, Coal India, ITC, Hero Motors and Dr. Reddy's. Meanwhile, on the losers end, we had Hindalco, Power Grid, Divi's Lab, Tech Mahindra and Grasim among a much longer list. For both a strategic and a short-term view on stocks, Business Today TV Global Business Editor Udayan Mukherjee and I spoke to Amit Jeswani, founder and CEO Stallion Asset. Here's a chunk from our conversation.
Amit, great to have you on the show. I see today that many fund houses, many PMS schemes have quite a bit of cash running on their books, including you. Has the market up move to 18,200 Nifty, etc., come as a bit of a surprise then? I mean, is there even a feeling that the market might be a bit ahead of itself?
So good evening, Udayan. Good evening, everyone. Thank you so much for calling me on this show. Udayan, this cash is for the earnings season. The markets are moving quarter se quarter tak. And the quality of the rally for the last 2 months has been very surprising. It's the neglected stocks which are doing well. The PSU banks, sometimes it's the defense companies, now the railway PSUs are doing very, very well. So the quality of stocks that we typically look out for, the ones which are growing at 20-25%, can reinvest capital at 25-30% ROICs, they've just stayed where they are. So the quality of rally in India is gone a lot more weaker than what we would be happy with. And 73% of quarterly numbers which have come down, the stocks are down more than 5%. Just tells you, if you're not a PSU bank, the markets are bidding you down on any kind of quarterly number. If it's very good, then the stock will be down probably 2%. If it's bad, then you're down 7-8%, which happened with TVs today.
No, this is an interesting observation, Amit. Is this making you suspicious of this rally, and is it a painful phase for a fund manager now, where you may be forced to think of whether to include some of these questionable quality stocks just to be able to keep up with the market? Or are you sticking to your horses and saying you will not dilute quality, even if that means underperformance in the near term?
It's very tough, Udayan, I should tell you, because if you look at the last, one utility company has gone from 1% of the market cap of Nifty 500 market cap to now 10% of Nifty 500 market cap. So you will basically the only way you outperform the benchmark is go even lower on the quality cycle. What we have, so that is very tough for any fund manager, and it's a view which every fund manager has to take. What we have done is we've also somewhat gone down a little bit, 5% of our portfolio down the quality curve. But the 95%, we're still confident that companies which grow at 20, 25, 30% can reinvest capital at 25-30%. That is where large long-term capital will be made. We cannot invest in banks where ROAs are less than 1%. Like SBI was, for the first quarter, did an ROA of 1%. Even if you're leveraged 10x over long times, of course, SBI has leveraged a lot more. Bank of Maharashtra has leveraged 17 times the book value of Bank of Maharashtra, and now Motilal is doing a roadshow for it. So this tells you that over time, if the price moves higher, everyone starts chasing those kind of plays. Like book value of Bank of Maharashtra 4 years back was 73 rupees. Last year it went down to 3 rupees. And now, since the government invested 10,000 crores, the book value has gone to 18 rupees or something. And basically these are not the kind of stocks you want to stay invested for long periods of time. You will have to go through a tough cycle, which we are already, but it's already been 1 year, like growth globally, not just in India, has underperformed. And of course, the first thing was to get rid of the loss-making companies, which of course globally there's no trend out there. But I am very confident that 2023, these kind of stocks will bounce back, and people who are flirting with very low quality companies may make money for next 1-2 quarters because they need to follow the trend, but these are not long-term decent bets. So globally, no large wealth creation happens in B2G company. That's the worst place to get your money invested in. The government doesn't care about shareholders. Their focus is and should be on public good.
So what is the right way to look at this leg of the rally? I mean, is it telling you in any way that the nature of the market has changed to focusing on lower valuations and underperformers now, and fund managers will have to include them in their basket? Or, as it has often signified in the past, it could be the last leg of the upcycle, current up move, where lower quality begins to outperform?
So this is the time where low quality rallies don't last too long. They're very, very, very painful. Typically they don't last too long, but the numbers of low quality companies are good. Like a South Indian bank, the NII growth is 37%, right? So there is a number backing also. The defense stocks also, the numbers are very decent. So it's not, this rally has not happened without numbers. So it's not going to fizzle out so quickly till the time the numbers are with them. So do we have to go down the quality curve like as a portfolio to outperform the market? If your horizon is 3 years, then you don't have to go down the quality curve. You still buy decent companies which can grow decently, because if your earnings doubles 3 years, I can with a lot of conviction say that so will your stock price. It might be 20-30% lesser, but that should be your trajectory. But yes, let's see. Udin, this is the most difficult, I would say, 6-8 months, 9 months that we've seen in the 9-10 years of investing that we are doing aggressively. So because it's a very tough call that you have to take, that do you go down and protect your alphas, or do you not go down to protect your alphas? For now, the ones who've gone down the quality curve, they've done very, very, very well. But over long periods of time, like a 3-4 year period, there will be drawdowns, and if they cannot exit on momentum breakdowns, they will, like example for Adani, for any stock, you need to have stop losses if you are going down the quality curve. So we are also looking at strategies, but we are not so convinced to go down the quality curve.
I want to get your view on financials. Amit, at a time like this, everyone's so gung-ho, and look at the recent spate of earnings, and the interest is spreading from private names to PSUs as well. What's your strategy when you're looking at the BFSI segment of the market?
So Abha, we were broadly underweight BFSI till now. Since COVID, we've been underweight. We're looking to add. We've been buying, like Axis used to trade at a massive premium compared to ICICI throughout last decade. Of course, the last 3 years, ICICI did very well. Axis was a laggard. But now if you look at the ROEs of Axis, they're now equivalent to that of ICICI Bank. The NI growth of Axis was 31% this quarter. NI growth of ICICI was 26%. And HDFC Bank, the net interest income growth was 18%. So HDFC is of course lagging, is now probably, if you take Bandhan out, the slowest NII growth this quarter is for HDFC Bank. No recommendations. We might have vested interest in these kind of names, but you need to look at the value part now. So as Udayan rightly said at the start, that we are also repositioning more towards the more cheaper, but still decent quality. You still don't go very down on the quality curve by buying a Bank of Baroda or a Canara Bank. You're still in decent quality, but that is what we're doing. Like something like Axis we added this quarter after the numbers came in. So that is the only game left in town, for us fund managers. Because if you start going down the quality curve, the game never stops. You go down the quality curve, you make money in one stock. The second stock, you'll do the same thing, and there probably you'll make money. The third time you do this and you lose whatever money you made in the last 2 times at one go. The question is not if, the question is when, and that will happen for sure in low quality. We've done that before. It's a very painful thing to exit then low quality.
November is all set to test the share prices of companies listed in the past 1 year. The lock-in period for anchor investors of companies such as Paytm, Nykaa Delivery and PB Fintech ends this month, meaning that these investors who backed the companies before they went public will have a chance to cut their losses if they so desire. Most of these companies are trading below their issue price, and if anchor investors decide to sell, it could see another fall in share prices. So what should shareholders of these companies do? My colleague Sakshi Batra spoke to Avinash Gorakhsakar of Profit Mart Securities on this entire issue. Listen in.
Why is this lock-in period being discussed as a worry sign, as a big concern?
See, I think, Sakshi, for all these 8 to 9 companies, pre-IPO money is something which is, allocated to institutional investors, and there is a lock-in period of 1 year. So typically what happens in the markets is that once the lock-in period gets over, we see a significant bout of selling from these investors because they are free to sell these shares in the secondary market. And historically, it has been proven that whenever the lock-in period of 1 year gets complete, these pre-IPO investors definitely decide to book out either the gains or losses, depending on what are the kind of valuations for these companies, what is the kind of growth outlook for these companies. So I think in the near term, as you rightly pointed out, there's a huge worry of a fresh supply wave in of paper in these companies, and typically most of these companies have incurred losses. So I think investors who want to get more liquidity would prefer to exit. So in that perspective, this is definitely a very crucial month, that is November. We may see a lot of supply across all these companies, at least in the near term. Afterwards, it's going to be earnings which are going to support these companies if at all they do perform better.
We've already seen some of these companies showing a sharp decline from their issue price of even 50, 60% odd, 70% to some extent as well. So further from here also, can we see, erosion of wealth?
See, I think my sense is, I think, businesses which are very strong inherently will definitely continue to do well. But I think businesses which are not incurring any operating EBITDA positive or which are, burning cash significantly, I think these are companies which inherently now investors have realized that these are quite expensive because there is no concept of valuations here. It's going to be quite stock specific, but across the board, some selling will be felt initially. And obviously, the ones which don't make cash flow are going to see a further fall, even if the stock has fallen by 50-60% in the last 12 months. So that's going to be the story, at least, which all investors need to face.
Okay. And I'm very glad that you made that point about valuations, because I was coming to that itself. Remember when these stocks had listed amid much fanfare last year, there was a whole talk among the analysts as to how we will have to value these companies much differently. The metrics will have to change because they're not making profits on the bottom line as of yet. But after this 1 year of performance, where we have seen most of them, in fact, make, substantial decline on the stock prices, does it really make sense that, come what may, bottom line and the traditional valuation metrics are going to stay, and that is exactly how the investors are going to value them?
So I think, Sakshi, you have made a very valid point that, even if these companies are not purely manufacturing companies, I think what is important is that most investors, especially the retail investors and the institutional investors, have realized that unless, the business makes a decent amount of cash flow and there is hardly any cash burn, the markets would obviously reward these companies with better valuations, and it's vice versa, exactly the opposite. If companies burn cash continuously and don't report earnings, cash positive on a slightly medium to long term kind of time frame, then these companies are definitely not going to be valued on metrics like price to sales or market cap to revenue. Another thing which I wanted to tell you is that most of these new companies have issued bonus shares. That is one other big worry for these companies. Nykaa has given a 4:5 bonus. So now the stock would be 200 rupees. So people may think it's a cheap share, but it is not a cheap share because obviously supply of equity is going to increase and the earnings dilution has been quite significant. So even this fact needs to be kept in mind by incoming investors.
So in the end, help me understand, and all the viewers also, that if one were to look at these companies with a fresh perspective now, which are the companies that one can still hold on to if they are already invested, look at as a fresh buy opportunity even now, and which ones would be a complete avoid and stay away from at this point?
See, I think, Sakshi, I would comment on the avoidable list first. I think Nykaa is avoidable because I feel that, the stock is still quoting come bonus. When it goes X bonus, we could possibly see a level of 200 rupees. And the 4:5 bonus has been very, very liberal. It's going to dilute the equity in a significant manner. Second is Policy Bazaar also seems to be struggling. So there also I would be a little apprehensive. And even Paytm for that reason, markets are awaiting that September 23, the company becomes cash positive. Till that time, I think it's avoidable. The only companies which I think look interesting are Go Fashion, which I mentioned now. I think very strong numbers, very strong retail franchise. Then Tarsan Products, which reported a softer Q2, but I think promising prospects for the longer term. And Ethos, which is into the luxury product segment, which does a marketing of watches and now have decided to enter the hard luggage segment. Would be interesting bets, if you at all get a chance to, see if the stock prices correct sharply in the month of November.
We take a very quick break. Back with more on the other side.
Make your media plan smarter with India Today Live TV on your connected devices.
Welcome back. Things are getting confusing for Twitter users. Elon Musk's takeover of the microblogging site and the flurry of changes has left a lot of users gobsmacked. Not only is there a new paid blue tick, but there's also talk of an official label. Business Today TV deciphers the difference between the two.
Since Elon Musk bought the Bluebird, promising to set it free, every day has brought a new development. First, he fired the entire top brass. Next in the firing line, more than half its employees, including 90% of the Indian workforce, and then the unkindest cut of all, an $8 monthly fee for the coveted blue tick. But there is another twist as well, that of the official label, which will supplement the blue tick in the Twitter hierarchy. So what's the difference? Twitter early stage products executive Esther Crawford explains. Well, the users will have to pay to get a blue checker or blue tick and the additional features. There will be no ID verification required as this is a paid subscription. Whereas the official label is a non-paid and verified account issued to government organizations, commercial concerns, business partners, major media outlets, publishers, and some public figures. Importantly, the official label is not available for purchase, making it the real deal for Twitterati. Having one against your name not only means that your account is verified, but also puts you in the stratosphere of the Twitter elite. Meanwhile, there is no certainty on how the blue ticks will work. Their purchase increases the chances of public figures being impersonated. The Twitter has already acted against impersonators and has assured its customers that it will keep improving its algorithms to perform the system. Bureau Report, Business Today Television.
Toyota all set to jazz up its India portfolio with the launch of a hybrid Innova. In fact, the company is betting large on alternate fuel technologies as part of the government's effort to clean the air. Business Today TV's Chetan Bhutani caught up with the company's vice chairman Vikram Kirloskar and started out by asking him about Toyota's experiments with hydrogen fuel and flex fuel cars.
India is interested, or the vision what the Prime Minister has put is a reduction in overall carbon as well as Atmanirbhar. And we're looking at all varieties of technologies that can achieve both. So we need a high level of localization of the product, not only the product, but also the fuel. So we are studying various options on that. And the second is also a high level of carbon reduction in our entire factory, our operations, manufacturing, supply chain. So both these activities we are pursuing, and that's why we have introduced, or we're doing studies on either the Mirai, which is a hydrogen fuel cell vehicle, or the flex fuel vehicle, which uses ethanol from 0 to 100%, and it's a hybrid as well. So the combination of both, we are trying to understand what is the effect on carbon and what is the effect on the environment.
Sir, I would like to ask you about the company. The company has, of course, now posted its highest net profit in the last 4 years. What are the reasons you think is attributing to that?
No, it's we've been doing generally well. During COVID, that 1 year we had a problem.
Right.
But basically, we have been doing well. This year also, it's doing. This year, our volumes have increasing quite a lot. Our numbers are increasing quite a lot because we've added a bunch of new models. And along with what Maruti is supplying us, also what we are making and supplying to Maruti in certain volumes. So both combination is adding numbers substantially. I think we'll see a big difference in numbers in the next financial year. We're still struggling with shortage of chips and things like that. You know, at times we are still having to break the production for 5 days, 6 days because of shortage of chips, and that is hurting us. It's not the order booking, but it's really shortage of chips, which is cutting our production volumes quite substantially. But I hope that gets sorted out, and by next year we'll be running at more than, at a very substantial volume.
Right. We are soon expecting the launch of the Innova Hycross. What are your expectations from that?
It's very good. You'll soon see.
Right. Of course. Moving on, sir. How is the partnership with Suzuki and Toyota coming along? I think the results have now started to show off with good volumes for you and for Maruti as well.
Yes.
I would like to ask you, what is the future looking like? And do you also plan to have some capacity expansion in that? Because you have already had 3 cars you're manufacturing for Maruti, and you probably could soon reach a point where you could want to expand. So are there plans, sir?
If I look at the overall industry over the last 10, 15 years, I think we are just about reaching our peak volumes, what we reached in 2017 or something like that. Okay. So I want to first I think we want to reach our full capacity first and stretch it before we think of adding more capacity. Working with Maruti has been quite excellent. We have learned a lot from them. We have also shared a lot of the technology issues with them. I think it's a good learning experience for both of us.
And that's where we leave it on the show tonight. Thanks so much for watching.
Make your media plan smarter with India Today Live TV on your connected devices. Everyone's busy finding what's trending. You're busy finding out why. India Today, for those who research before reacting. Download the India Today app now.